Good morning. How are you doing? How are you doing with your review of the material? I'm going to go a little back in the notes. Oh, I want to talk to you about the tests. I am in the process still of grading the tests. I've done like halfway job, but I think the second half is going to be faster because I got a rhythm going. The thing is, they were not done very well at all. So we'll have to sort something out about that. You guys need to catch up. You need to study the documents I've given you, practice, and watch my videos again. It looks like you're using formulas, other versions of the formula, which is with other formulas, which is fine. But you need to know how to use them. And it's not so clear. So I'm just going, like I mentioned, I would mark 2 questions out of 5 and the remaining questions out of 1. And I actually gave some half points. I didn't make it 0 or 1. I was feeling a little generous. So you might have half a point out of 1 rather than just 0. And the total test is then out of, because there's 7 questions and 2 are out of 5, that's 10, and that leaves 5 out of 1, so it's out of 15 points. All right, so I should have that done today in the afternoon, and I'll send them. So have a look at that, and you still have the question paper. I mean, you should be able to solve those problems. And then I gave you a number of other problems to solve as well. And I don't think I gave you the solutions, did I? I just gave you the problems. Let me verify what I did. Do you have any comments on the test? So I gave you, okay, so yeah, I gave you more 216 and 217, which I guess, just verifying, 216, 217. I gave you the answers. So you should be practicing those. You should be practicing those problems. And you should be letting me know if you have problems, difficulty, challenges. So among the problems I shared with you were the solutions to the test problems. So there are a total of 20 problems, and I think 7 of them or 5 of them are from the test. So you should practice those, okay? And today we're going to finish off Unit 4. I'm going to backtrack a little bit. Regarding net operating cash flows and this derivation that we made for net operating cash flows, which included net revenues after tax plus the tax shields. And I explained that depreciation is not a cash flow. So if this is the income statement, in terms of cash flow, we don't put depreciation here. However, okay, so we have everything looks the same until depreciation. Depreciation does appear in the income statement, but not in the cash flow analysis. So even here, like, okay, so here I'm saying without depreciation at all, but here I'm allowing depreciation, but still it does not appear here like the income statement. Where it appears is that it reduces the taxes, because when calculating taxes, you have to do it on 30 minus the depreciation of 10 and multiply that by 0.4. Let me write that again. And that's where the 8 comes from. And that turns out to be less taxes than without depreciation. So it does increase cash flows. And determining what D is, I just put a number here. Just to make a note, where did that number come from? To say we found D, depreciation, to be 10. So you'd pay less taxes than if you didn't include depreciation as a taxable expense. I mean, you could not include depreciation, but that's not advisable, right? Because you show higher cash flows here, higher future cash flow here. And just recapping what we did, we went through and divided up our incremental cash flows into income, investment cash flows, and tax shields, calculated them each, and found the NPV. The NPV was positive, which meant invest in the airline to the Bahamas. We're flying to the Bahamas with the airline. And then what I did here was put all of the cash flows for 1, 2, and 3 in one table. Now you can do this as well if you like, but you need to be able to do both. This is known as a total project cash flow approach, and it looks more like, the result is more like what we've been getting until now, a stream of future cash flows. With these values now, I can actually calculate the IRR, and I find that it's 10.26%, which exceeds the 10% predetermined required rate of return, so we should invest. So we've answered the first question from the case. The second question from the case is express the cash flows as as real, and then using the real rate derive the same answer. So it turns out, in terms of real cash flows, I can use this relationship between real and nominal, deflating all these cash flows that I see as nominal and making them real. And this says to us that by the end of year one, you could buy $3.4 million worth of stuff with that amount today, and you should be able to buy the same amount of things or the same variety of items in year one. In year two, this is real cash flows taking account of inflation. For 2 periods. So this amount is, well, let's go for this one first. So this is 3540 deflated 1 period. And this is 8280 deflated 2 periods. And so on. I'm having issues. I just want to put that arrow here. Okay? And so on. I can do the same for incremental cash flows. I can convert them to real cash flows after the first year or in the initial period. So discounting this about by 1 period of inflation, this one by 2, this one by 3, and this one by 4. Now, in terms of the tax shields, in reading the case, it explains that assume that the annual inflation rate is 4%. Calculate the NPV of the proposed Bahamas line based on its real cash flow. Note that using real rates of real dollars leads to a problem with tax shields. Depreciation is deducted in nominal dollars, and so we cannot express the formula in real terms. Thus, the tax shield can be estimated only by using nominal dollars and nominal rates. So we're going to leave the tax shields alone. We're not going to edit them. We'll leave them as nominal. And then that portion needs to be discounted at the nominal rate. So we need the real rate. Let's get the real rate. We convert the nominal rate into a real rate, and you get this amount. you could verify taking those cash flows on the other page, these ones here, and discounting these with the real rate, and discounting these with the real rate, you'll get these two identical amounts like as we had last time. But we don't otherwise do anything to the tax shields. Tax shields are a stream of nominal cash flows. So you go back to the original cash flows and you discount them with the nominal rate. Anyway, we already know this answer. And we should get the same result if we use real dollars and the real rate must give the same NPV. Any questions? The next step is to solve a variety of problems. Why is that 4.2? Okay, so 4.3 is the first exercise. So here's the first exercise, document 4.3. So you'll see that some cases are shorter, some are longer. You should practice with the variety that I've shared with you in preparation for the weekend test. A company with profitable ongoing operations is considering a major project. The company has completed extensive research and development testing on a new product at a cost of $150,000. Is that an incremental cash flow? No, that's a sunk cost. So we don't include it. If the company goes ahead with the project, the company will be required to invest $600,000 in new steam and electric generation machinery. This equipment belongs to the asset class 0.4 and has a general depreciation schedule of 15 years. So this is part of Maker's table for 15 years. I don't think you have 15 years in the one I gave you. I'll double check, but I don't think so. So I've given you it here. Yeah, I've only gone up to 10 years in the one that I gave you. So what do we need to do? It is expected that the project will generate incremental revenues of $300,000 per year for each of the 5 years of the project, and incremental expenses of $50,000 per year for each of the 5 years of the project. So this is incremental. It tells you it's incremental, and I agree. Oops. This is incremental. the project is 5 years, and this is incremental. So the project is 5 years, you gather. It is anticipated that after 5 years, the project will end and the equipment will be sold to a competitor for $75,000. So this is called the salvage value. Oops. The company also anticipates that it will have to maintain its working capital requirements above its regular levels as follows. So you get this information for working capital requirements. So this is the first row of the table you need to generate on net working capital investment. It is further anticipated that at the end of the 5th year, hold on, let me check my connection. How is this streaming? Always confused how it's streaming. Is it still connected? Did I lose the connection? No, it's connected. Okay, so the company anticipates, okay, so we have this information on working capital. It is further anticipated that at the end of the 5th year, working capital requirements will return to the pre-project levels. So this is talking about having zeros, right? A zero in the last year, by the end of the last year. An additional complication of the project is that it is expected to cause a labor shortage to the company's other plants. This will result in additional overtime costs estimated to be $20,000 per year for each of the next 5 years of the project. So what do we call that? So this is as a result of taking on the project. This affects other operations of the firm. In that sense, it's a side effect. This is a negative side effect. And the result is incremental expenses. What else? The company pays income taxes at a rate of 40% and has determined that the discount rate appropriate for the project is 10%. All right, so we have that information. So this is a smaller case than the one that we just worked with. We will divide up what is each of those three parts, right? We want to make sure we have income accounted for, investment cash flows, and tax shields. So which components will go into income? So this will go into income. This will go into income. And the side effect will go into income. So incremental revenues, expenses, side effects will all go into income. Did I miss anything? No, I didn't miss anything. So let's look at investment. Which portions go into investment? Well, there's a purchase of equipment up here. So that will be the capital spending that we're going to depreciate over time to earn tax savings. And also use the asset to carry out our project. Oh, I left it up there. I didn't mark it today. No, that's not there. Okay, this equipment, $600,000 for that equipment. So this is capital spending or initial investment. And it goes in, it enters as investment cash flow. What else is an investment cash flow? What else is an investment cash flow? It would be we have to include the salvage value and net working capital. And finally, we get the tax shields from this purchase. So I'll make a point that this is also going to help us get part 3, tax shields. So you have the document. I'm going to give you 5 minutes to lay out income. I'm going to close some doors and make it a little quieter. So how's it going? So I made some notes on the next page. For income, find the present value of the after-tax net incremental revenue minus expenses and subtract the present value of the after-tax side effects caused by labor shortage due to the project. So I'm suggesting here, don't make a table because the cash flows are level. I mean, they're all the same amount. You can see this as an annuity and you can calculate this very easily. So we begin, let's do one at a time. So the present value of income is going to be made up of two components. The present value, actually, you know what I'm going to do is take it from the quotation, just quote it. Okay, so we want the present value of after-tax net incremental revenue minus expenses. Well, what's that going to be? In each year, it's going to be $300,000 revenue minus $50,000 expenses attributable to the project, and that's going to happen for 5 years. Discount rate is 10%. And then, well, actually, I'm going to put it, I'm sorry, I'm going to erase this. Let me erase. I'm going to write this after tax. So it's revenue minus expenses after tax. Confirm it's 40% tax rate. Yeah. And then complete the annuity. So that's that amount. And you put this in your keys, so you simplify this amount here, and you put it into your TVM keys to find, because this will be 250,000 times 0.6 it works out to be 150,000. So you're going to enter 5 into N and 10% into interest, and then PV is what we want, and you tell it 150,000 into payment, and then 0 into FV, and you compute PV, and the answer that you get is 568,618.02. Any questions? Now we have to get the next part. It tells us about the next part, which is subtract the present value of the after-tax side effects. So you should never forget that for net operating cash flows, you have to take all the after-tax quantities. I don't need that part. That's not what I want to do. So now I want to compute the present value of after-tax side effects. The side effects are a result of a labor shortage that is interpreted to have a 5-year impact. Let's read it through. So it says the project is expected to cause a labor shortage at the company's other plants. This will result in additional overtime costs estimated to be $20,000 per year for each of the 5 years of the project. So rather than giving wage increases, they allow overtime and pay extra. This is incremental to their previous expenses. So it's only for 5 years. This impact will be 5-year impact of $20,000. That's an expense. And I only separated it from this portion because I wanted to emphasize that they're side effects, but it also falls in income. I could have put them all together in one, but I wanted to separate it out so you could see that $20,000 after tax for 5 years is what we anticipate. So this will be negative. And you can verify that it's $45,489.44. How's it going? Are you getting my numbers? Are you understanding and able to compute them? So I round these to two decimal places for cents, like dollars and cents, and I combine them all at the end. And that's it. So I'm going to put those together for present value of income. I'll put a divider here. So this is equal to this amount minus or plus this amount. Which makes $523,000. So 523,128.56, or 523,128.56. So it depends on the instructions. If I have no instructions, you can do whatever you want, but if there are instructions, follow them, and usually I have the instruction that you should round final dollar answers to decimals. So there's the answer. So I'll circle that portion. That's income. Ready for investment? You multiply all this together here, and you see this ended up being $150,000. So all I did was multiply $250,000 times 0.6. You multiply these and do the same thing. Here you have 5 years, 10 as interest, PV is what you want, and this is just 20,000 times 0.6. What's 20,000 times 0.6? 12,000. Okay, so that's income, part 1. Let's look at investment now. So for investment, sum the cash flows from A, B, and C and D to compute the present value of investment. So A is the present value of the initial investment is a negative cash flow. Part B, at the end of 5 years, the capital purchases at the start of the project will be sold for $75,000. Determine the present value. So since part C is determine the present value of selling this asset by computing any tax savings or tax payments that result from the sale of the asset at the end of the first of the 5 years of the project. You will need to compute the book value of the asset at the end of 5 years in order to do this. And then D, determine the net working capital required for the project. And then net working capital investment, and compute the present value of net working capital investment. So this is what we're going to do. I've laid it out for you. So this is the present value we have first, part A is the present value of the initial investment. And you're told that it's going to cost you $600,000. And that's a negative cash flow, so $600,000. With a negative in front. Now, for part B and C, we need to generate the depreciation table. Now we have the amounts, and we have to draw from the last problem the headers for that table. So let's pull up those amounts from here. I just need the first 5 years from here. Thought I grabbed it. So in the table, we have to put D first. Then we put the big D. So the little d is for the rate. Then we put the big D, that for depreciation, that is always multiplied to 600,000. Your D, little d, multiplied to 600,000. And then you calculate the UCC, the undepreciated cost of capital, which I say is the UCC, the old one, minus the depreciation. And then finally, the tax shield column. So copying out these values here, this is going to be 0.05 and then 0.095 and then 0.0855 and 0.775, no, just 77. And then 6.93. Nope. Any comments? So let's go row by row. For the first one, you take 600,000 times this. So in the first year, you can depreciate $30,000 as an expense, thanks to the IRS. And that will reduce your taxable income. I'll just jump over to here. Let's compute the tax shield. The corporate tax rate is given as 40%. So $30,000 times 4.4 is going to give you $12,000. Okay, so you will save $12,000 in taxes, corporate taxes. Substantial sum of money. So what does that leave? That leaves 600,000 minus 30,000, or $570,000 in assets. In this equipment. That's the value of the equipment, the book value. So then we go to the next row. The next row is 57,000 is our D, and then our depreciation or our tax shield resulting from depreciation is 22,800. So now I'm going to take 570 and subtract 57,000. which leaves 513,000. More furniture being moved. Okay. And the next row, so you could do this in Excel. You have to program it properly. Now you know how to calculate. I can put them up. And the last row, this is going to be 41,580, leaving 373,920, which we will call the book value. And 16,632. As a tax shield. Okay. The next one I'll do in Excel. I did this one by hand, but you should be able to do this in Excel easily too. Much easier, actually. It's just a problem if you make a mistake in your programming, the whole thing is wrong. So you have to be good at it. So this is the book value. So what is the salvage? What is the market value? We're told that it's been estimated that we could sell the equipment in 5 years for an amount. Let me erase this. Of $75,000. $75,000. So the market value is $75,000. So that's a huge loss, which you can claim. It's a huge loss because you're selling something worth $373,920 for only $75,000. So that's a tax savings for you. You get to claim that, and as just like the tax shields, to find them, all you do is multiply the difference between these two by the tax rate. So I'm going to remind you that there was this formula that I didn't use yet. I think it's all the way over here. Here it is. Okay. So this is the formula here. Right? So all we do is to find the impact or the incremental value associated with this sale of the asset. This is it. You have to see what is the difference between the book value and the salvage value. If it's a positive, so you're selling at a loss, this adds to your income or to your, it's an incremental cash flow. Now we don't put it in the income section, but it's like income. We're going to put it in the investment section, so all the investment cash flows are together. So how do I do this? I calculate the present value of salvage equals the present value of this whole thing. And I put the numbers in. This does drive me crazy when this happens. All right. Go together. And the salvage was 75,000. The tax rate was 40%. The book value was 373,920 minus the salvage, which is 75,000. And get the PV of that. So we get the money for the sale, but then the tax treatment of that sale gives you even more. So I have to say present value because this all happens at year 5. So I need to, when I put the number together, I get 194,568. And I need to discount that back for the present value. And you get 120,000, 811.42. So I figured out parts B and C. And the final thing to do is to make the table with net working capital. So A was the initial investment. B and C is how I deal with the sale of the asset. And then E is net working capital, investment, cash flows. So for this portion, I make the table. The table starts with year 0. And you put here the net working capital required to begin with. So where do we get that from? Net working capital required. It's from here. So enter those values onto the table. Sorry, this will be a positive. Too many zeros. Okay, so that's those are the required amounts. So the table isn't full of numbers. I gave you the required amounts to simplify things. So these are required. Now you want to compute the net working capital changes. From year to year, remember we're interested in incrementals. That's why we can do this, or why we're interested in this. We begin with $50,000, but then we need an additional $30,000 to operate this project. And then nothing extra, nothing extra, nothing extra. And then in the final year, we release $80,000 to the other operations of the firm away for this project because we closed this project up. So that looks like a release. And then finally, net working capital, investment cash flows. What do those look like? And so that's a matter of looking at these cash flows and saying, well, these are not from the perspective of the firm. These are just amounts for the project. You need 50,000, you need 30,000 extra, etc. But from the perspective of a firm, change the sign, because that isn't actually an investment, and 30,000 is actually an investment. There will be no investment, incremental cash flow investment in years 2, 3, or 4. Oh, sorry. 2, 3, or 4. But by the 5th year, the firm sees $80,000 recovered. So remembering that these are cash flows set aside for the purpose of this project, for inventory, for accounts receivable, tax payable, etc. All right. Then I can calculate for Part D the present value of net working capital investment. And I just take these cash flows and work with them. So it's just negative 50,000 up front, then minus 30,000 for 1 year, by the end of year 1. And then it jumps all the way to the 5th year. Don't forget to keep track. This will be $80,000 to the power of 5, because it happens in the 5th year. So this works out to be 27,000. It's an investment, right? So 27,000 negative $599.02. So what do we have? Are we done? A, B, and C. Oops. So all right, so I have part A, negative 600,000, right? The initial purchase. And then B, did I erase my B and C? Okay, so B and C come from here, and it's here. Things disappear. And we put it all together. So this amount, which is a negative, add it to this amount. And add that to this amount, which is a negative. What do you get? You have like negative, almost negative 90, and 120, it leaves about 30 million. So the answer, when you add all these, it turns out that the investment is going to be equal to right, because we have 600,000 negative plus 120 minus 30, we actually get $506,000 as an investment, so it's a negative. So we thought we were doing great with income, but look at the investment expense. So that's part 2. Now we got to pick up these tax shields here and discount them and add those into the mix. And see if it makes the project profitable. So the third piece is to take these amounts and for part 3, you want to calculate the present value of tax shields over time. And this will just be equal to, remember this is after the first year, so I'll put a place mark of 0 for the initial year, but then it's 12,000 discounted by 1.11 plus 20,000 discounted in the second year by 10% discount rate. And then no, I jumped a figure. It's okay, I'll fix that. That's really 22,800, and then 20,520 for 3 years. Keep going, 18,480 discounted for 4 years. And 16,632 over 1.1 to the 5. So what is the value of this amount? So you should be using your CF keys. Oh, you guys can't even see that. There. What do you get? What you have to do is go to your CF keys, clear, second clear work, and enter. First 0, enter down. And the first cash flow, 12,000. Enter down with a frequency of 1. And then 22,800. Enter down. Sorry, what happened? Do that again. So first it's nothing, it's 0, and then 12,000 and down, down. The second one is 22,800. Enter down, down. Then 520. And 18,480. And 16,632. And now you can ask for the NPV. It asks for the discount rate. You say 10%. You enter it and scroll down and ask to compute. And I get $68,118,000. $68,118.30. I said that incorrectly. So 68,000 $118.30. And finally, I'll circle that as part 3, and now I have to add, so this is all you have to do at the end, is say the net present value of the project is equal to part 1 plus part 2 plus part 3. And when you add them together, you should have, so you could store each of these in your calculator as you go, so you don't have to retype them. That's up to you. 84,459.26, and we have to believe, that we have included all incremental cash flows in this analysis, and given that the NPV is positive, this means invest. Questions? So I can send you the tidy solution set, nice and neat and tidy, okay? Shall we go to the next problem? So this one was a giveaway because I told you exactly what to include, but hopefully it was instructional so that you see that this is all that's expected of you and you replicate this exercise, some version of it. Okay, I'm going to skip that first part. I'm just going to jump to number 2. So here we have another project. Again, smaller, even smaller yet than the initial one we had. So you see, you can practice with smaller cases. And this time I'll use Excel. No, I'm going to do this one with annuities as well. But Excel for the depreciation table, the schedule. All right, so as a newly hired financial manager of the Espresso Roast Corporation, you are considering the following investment to produce specialty roasting equipment for the next 4 years. The required investment in machinery is $40,000. After the 4 years of the project, the machinery will be sold for $12,000. According to makers, the firm can depreciate the investment using the 7-year depreciation schedule. The firm is in the 40% tax bracket. The price of your product will be $300 per unit and will remain constant for the duration of the project. Labor costs will be $12 per hour. They will increase at 1% per year. Energy costs will be $5.15 per physical unit. They will increase at 3% per year. Revenues are received and costs are paid at the end, at year end. The required rate of return is 10%, and now I ask you to conduct an NPV analysis. And here in this box are the units of input and output sold. So what do we do with this information? We need to divide this into income, investment, and tax shields. So let's read it again, and this time identify incremental costs and categorize them as income, investment, or tax shield. So this is a 4-year project, and you're told that there's going to be investment in machinery, so that's investment, right? After the 4 years of the project, the machinery will be sold. That's an investment amount as well. So both of these go into investment, which is part 2. According to makers, the firm can depreciate the investment using the 7-year schedule. The firm is in the 40% bracket. Okay, the price of your product will be $300 per unit. So this is revenue. This will be income. And will remain constant for the duration like that, because that's important. Energy costs will be $5.15, so this is a cost, and they will increase at 3% per year. So all that information is important. So those all go into income. The required rate of return is 10%, and then you have all this information. Where does this information go? How do we use it? So this part will go into incremental revenue. This part about labor inputs, energy inputs will go into incremental expenses. So that's how we use those numbers. Yeah. I lost connection when I started writing. Okay, let me see. Yeah, it broke. Thank you. So that's what I wrote. So this would go into incremental revenue, and this would go into incremental expense. These are the units of output and input, and the costs or the revenue per unit is given up here. So can I give you a moment to try and at least put together income? Let me give you 10 minutes. I'm going to give you 10 minutes to put together income. So how's it going? Let's look at income together. So the first part is the present value of after-tax incremental revenues. I'm going to treat this as annuities. Is equal to the present value in the first year, or initially there's nothing, right? And then there'll be 100 units sold. We estimate 100 units sold. And then 200 units in the second year. $200 in the third. And $150 in the fourth. And all of these in each year will earn $300 a unit, and then taxes have to be paid on those revenues. So that's what it would be. So what you can do is find the NPV of this first, and then multiply this amount. This is 1.1 to the 4. What do you get? So as I said, get the NPV here first. And then multiply by 300 and then 0.6. You can do it. This is just the revenues. Then I'm going to do the calculation for expenses and add them together because they're different formulas. Okay, the revenues are just an annuity, or not annuity. This is just a mixed cash flows. But the expenses have growth. So we're going to do that after. So tell me that value first, and then we'll get into the next one. Yes. Then multiply by 180. What do you get? Got a number for me. Very good. Let's see. So I get 91,604 and 40 cents. Okay, you guys are close. Some of you got it. Okay, good. So next, the expense. The expense includes this information on units with the changing prices. Okay, so it's $12 per hour for labor costs, but increasing at 1%, and $5.15 per unit of energy cost, but increasing at 3%. So I need to put that information here for expenses. Now expenses will be subtracted. I'm going to have to take revenues minus expenses to find present value of income. Yeah, you should round it to cents. You should round it to cents. And if you don't want to have to type that number again, store it. Make a note. Store 1. Because transcribing that number on your calculator to add later can create an error. So expenses will be For labor, 2000, 2000, 2000. So it's consistently 2000, and same for energy. So let's remember those numbers. 2000. So we're going to deal with labor first. And then that's, oh sorry, units. That's not dollars. That's units. And I'm going to multiply that by the dollar rate of 12 initially. And then it is a growing annuity at 1%. So at 1%, it's going to be I minus G on the bottom. And then the adjustment, because it's an annuity, not a perpetuity, the G on the top and the discount rate on the bottom for 4 years. Okay, so now what's missing? What did I not put there yet? What did I miss? So this is for labor, and labor has 2,000 units at $12 a unit and increasing at 1%. Energy, oh, so I asked what is that? What's missing here? After tax. Don't forget the after tax part. So when you're doing income, we have to tax it. It's an expense, so it actually garners tax savings, and so the tax treatment reduces the labor expense. So we need to make it smaller by multiplying with this 1 minus TC. And TC is 10%, so it's 1 minus 0.4. You can put it there, you can put it over in the front. I'll put it in the front. I don't want you to forget it, so that's why I left it out, so we could talk about it. Oh, let me put it in there, 0.4. So basically you're multiplying these by 0.6. And that's the first. So basically, you're multiplying this whole annuity, growing annuity, or annuity with growth after tax, with the after tax amount of 0.6. What about energy? So let's mimic what we just did, but with energy, it's 200 units, and the unit cost is $15.15 per unit. So I'm going to do that. So it's like this, 15.15 after tax. And then it's growing at 3% for energy costs.
what did I just do? That's not right. It's I minus G. So I is the same, 10%, minus G, which is 3, and then the annuity portion with 3 and 1.1 to the 4. Did I make any errors? Did I miss anything? That's 2. All right, so now you need to put those in your calculator. Remember how I taught you to punch that in. Okay, so let's start storing these values. So I'm going to add these together, right? I'm going to add these together and then subtract the total. Does anyone confirm Kevin's result? Oh, this is a typo. Well, maybe a misguidance, because this has to be an exponent to both of these, right? It should be up here, not just on the bottom. I did the same thing here. I hope you knew that. If not, now you do. Energy is 515, yeah. 515. Yep. I'm going to send you the clave later, but you guys should be paying attention and catching my mistakes, either purposeful or accidental. All right, so how are you guys doing with the first part? Are you getting what Kevin gets? So 1.01 divided by 1.1 to the power of 4 negative plus 1 equals times 0.6 times 12 times 2000 divided by 0.09. Yeah, I'm in the 40s, Kevin. Okay, yeah, sorry. So now you don't forget that this is up here on both of them. So punch that in again. So I get 46,280.55. And I can store all those decimals if I store it in 2. And then for energy, starting again inside the brackets, 1.03 divided by 1.1 negative plus 1, no. 1.03 divided by 1.1 equals to the power of 4 negative plus 1 equals times 0.6 times 5.15 times 200, and then divide by 0.07, much smaller number. So what do you get? And I'm going to store that in 3. So I'm going to add those. Don't forget there's a negative in front because it's an expense. And putting those together,
48,322, and I'm going to round it to 27 now, and I'm going to store that in 4. I'm going to store them in different keys, so then I can verify later. So what do I have? I have what I'll do is I'll get rid of this and just have negative. So what I want to do next is take store 1 minus store 4. And put my result at the top. Not store, I'm going to put recall. And so what do you get? $43,282.13. I did put some exercises in Connect, I think I told you yesterday, that you can just use for practice. And I made it so that once you submit it, you can see the results and you can keep studying if you like. I don't think I put a deadline on it, just like the last day of class. All right, so that's income. We have 2 more parts to go. What goes into investment? In this okay, does anybody have questions about income? So income is $43,000. For investment, we have the purchase of the machinery, and remember, I'm not going to include this as an expense after tax. That's why I put it in its own category. What I'm going to do with it is expense using the IRS rules for 7-year depreciation and expense it over time, and as a result earn tax savings over time, substantial tax savings. And then we're going to sell the machinery at the end for $12,000. So we have to find out what is the machinery going to be worth at the end of 4 years. So let's go into Excel to build that table. So what I'm going to do is put D, but I want to put lowercase d. I want to put lowercase d. How do I put lowercase d? And then big D is calculated as, I'll put the formula here, $40,000 expenditure times little d. And then UCC, and finally TC times D. So the D's we get from the schedule. Which schedule are we using? 7 years. So I'm going to use the 7-year table. So you remember these values here. See if I can take them with me. But I want to, there you go. All right. So I'm going to take this with me. So I'm going to move it over a bit. Don't want it right there. All right, so I'm going to use that to extract the numbers. So 0.143, 0.245, 0.175, 0.125, and it's just a 4-year project. Is it? Yeah. Then I want to calculate D, and D is always going to be $40,000 times this rate here, all the way down. And the UCC, let's do the tax shield first. So the tax shield here. I'm going to put a border around this so that you see the header separate from the values. So this is equal to, in this case, 0.4 times the depreciated amount. And I do that all the way down. And I tell Excel that these are numbers. I want to format Excel on the iPad's a little different. I'm just not familiar completely with it. I want to make it dollars anyway. Leave it for now. And then we want to calculate the UCC, but you see the tax shield is $2,000 in the first year, then almost $4,000, almost double, right? It should be double in the second, and then the third, and the fourth. Now, these are all future cash flows that we need to discount. In the test, if you give me an Excel sheet, you have to show me all the formulas, because if you make a mistake, you get it all wrong. So at least if I see the formulas, I can give you some credit or part marks. So it's risky, kind of risky, but I leave it to you. So then UCC will be equal to 40,000 minus this depreciated amount. That's the undepreciated cost of capital. And then in the second year, it'll be this amount, the remainder, minus the additional depreciation. And then in the third year, at the end of the third year, it'll be whatever's left minus that year's depreciation. And finally, not that one. We are left with this amount. Which is the book value. So that's the book value. But we can sell this for $12,000. So what I'm going to do is take this chart over with me back to the case. Put it on its own here. And we take that expression, remember the expression from the salvage from here. And I'm going to put it here. And the book value was $12,480, but the market value, or the salvage value that we can sell it for in the market at the end of 4 years, is estimated to be just $12,000. So as a result, we can compute the effect of the sale. It's 12,000 plus, and we see if we have a tax benefit from doing this. Well, notice this is going to be a positive. So yes, we're going to incur tax savings, right? Because 12,000 is smaller than 12,480. So this ends up being 192. So you make this in terms of tax savings in the fourth year, in year 4. From the sale of the asset. So we need to discount that all right. So that's the present value. This was just in year 4. We have to assess if there's going to be a tax effect that impacts us. And in fact, yes, there's a capital loss, which we can claim because we sold it for less than it's worth. And then these are all incentives for doing business. And then this is what we have to discount at the end of the 4th year. So this is a positive cash flow. And I put that together with the investment cost. Which is immediate, and it's just negative $40,000. So if I put those together, what I get so you say therefore the present value of investment is just the sum of those two. The initial expense, capital spending, plus the benefit from the sale in times $0. It's present value. And so that offsets the investment cost. And so this is the cost of investment. So this is part 2. So we have part 1 was income, and we got $43,000. Investment was $31,000 negative. So this is an expense. This is a cash outflow, right? This is a cash outflow due to the investment. We offset it a bit by selling the unused or the remainder of the value of the equipment, and realize the tax savings because of the capital loss that we claim. And then the last part is the tax shields. All we do is take these amounts here and discount those. So I'll take them with me. So the present value I'm just going to put this here so it's closer for my viewpoint. So the present value of the tax shields is, there are none in the first immediately, right? They start in the first year. So 2288, and these are in thousands of dollars, or they're in dollars, and that's going to be over 1.1 plus 3920 over 1.1 squared plus 2800 1.1 cubed plus 2000. So these are mixed cash flows. So use the mixed cash flow key, the CF keys. And what do you get? Oh, we're almost done. So let's finish this. So all these amounts could have been stored as you went along. Store this one in 1. For income, store investment in 2. And then tax shields, well, after you've added them, or you've put them into the NPV calculation on your calculator, you get 8,789.38. And say store 3. And then you put them all together, and what do you get? And your final answer is 20,398 81. So it means that this is positive and you should invest. Presuming you've taken all the information available into consideration, this accounts for all possible costs and revenues, investment effects of sale of the asset that's purchased as the initial investment. So just a couple of questions here. Did this seem easier than the other one? I don't have here. There's no net working capital for this project. So I don't have that table in my analysis, okay? And you could put everything onto one table if you like. You just, like I say, you have to be careful when you do that you make no errors because it affects the entire table. But you could, if that's what you like, if you're more of an accounting type student and you like tables and Excel, you can work with that too. So, I think I gave you 2 more exercises. Let me see what I gave you. I gave you so 2 more exercises. Okay, so prepare those 2 exercises and prepare them completely for tomorrow. And we'll begin tomorrow looking at them. And I'll answer your questions. And then we will get into the statistics review. All right, so you'll get a feel for the repetitiveness of these problems. If you have questions, text me in the day so I can clarify them. I just wanted to check one thing because I feel like I missed something in this problem, but I did the tax shields. Yeah, I did it here. I did everything. I just kind of fell asleep. So tired. And I forgot that I did that. So I did everything. So you have these that I've calculated online that you can review. I apologize for being a little out of it today again. I'm working late nights trying to get everything done. I am teaching another class in the summer as well. And I'm going to send you the nice, clean version. And I'll send that right now. So do you have any questions for me? So collect your questions in anticipation of tomorrow. Work on those 2 remaining cases for tomorrow. Also, you have those problems from the first week to practice. So you have lots of stuff to do. Keep yourself organized, keep a schedule, make sure you take breaks, enough breaks that you feel refreshed, and get some good sleep in the evening, and take it easy in the day because we are halfway through the course. Can you believe it? Can you believe it? We're halfway through. So you should congratulate yourself for staying in the course and sticking with it and dedicating yourself. You're going to be fine. It seems overwhelming, but you're really going to get this, okay? I know it. Just keep up with my instructions, and you might not feel confident today, but come Sunday you will, once you hand everything in. All right? So have a good day. Keep me posted if you have questions. I'll send you those tests, and don't be upset about the test. We'll talk about the test situation, what we can do to improve your grade next class. Okay? Okay, you guys take care. You too. Have a nice day.
This is the one we just did.
Bye bye.